Okay, welcome, ladies and gentlemen. Delighted to start the Global Corporate Venturing Digital Forum preview webinar. We've got a fantastic set of guest speakers joining us in Paul Holland, Managing Director of the Corporate Investing Practice and VC in Residence at Mach49. Helen Crampin, the Innovation and Technology Lead at UK Research and Innovation, particularly focused around healthy aging. And Stéphane Longuet, from Managing Director of Convivialité Ventures, which is Pernod-Ricard's corporate venturing unit, and just below the screen, pulled forward off, is Sukhjinder Singh from Pear.AI. He's the CEO over there. So welcome to you all. What we'll do for this exciting webinar is do a quick review of some of the data and some of the GCV analytics insights of what's been happening, particularly in the corporate venturing community through COVID-19. We will then go forward into sort of Paul Holland from Mach49 to give a quick overview on some of the sort of insights from their corporate clients, of which Stéphane is one. We'll then turn it over to Stéphane and Sukhjinder and Helen to give quick introductions and updates from their views, and then we'll go into the discussion on what they've been seeing, how that very much is reflecting the overall innovation capital ecosystem. We're delighted to have a record number of sort of attendees to this webinar, so we very much want to encourage the Q&A through that discussion period. But we'll start off with some of the very much the overview of the I've got participants, we've got the attendees of the sort of some of the data. So as mentioned, this is what all these folks look like. They're delighted to have such a sort of diverse and sort of experience set from the entrepreneurial through the CVC, through the consulting and venture capital perspective, and up into the sort of the government and research enterprise. So, but a little bit about us and what we're trying to achieve with this webinar. It's one of the things that we do as part of Global Corporate Venturing suite of products. We're a media company, published and produced by Mawson as a publishing group. And it's one of the publications that we do. We also look at how universities support student and faculty spin-outs and startups, as well as governments and others as they focus particularly through the United Nations Sustainable Development Goals, which we call Global Impact Venturing. The webinar is just one of the things we do. We do obviously the news and data that comes from our website, globalcorporateventuring.com, the Training Academy, GCV Academy, and also we have a membership community, GCV Leadership Society, which helps pull together some of the sort of community, particularly the top 20%, which are responsible for about 80% of all deals and activity. And that's all come together through the GCV Connect platform, and we'll talk a little bit about that in our partnership with Proceeder. So just a quick summary of some of the data we'll talk through in the next few minutes, but we actually saw a record inflow of corporations entering the corporate venturing ecosystem in the first 6 months of the year. That's a little bit surprising if you look back, not just through the dot-com days or 2008, but before that, over the past 60 years, corporations have often been effectively pro-cyclical. They've tended to do more towards the end of an economic cycle and less during a recession or during a downturn. So the fact that corporations are increasingly stepping up and starting or engaging more in corporate venturing and the wider innovation ecosystem, I think it's a very positive sign for what this community in terms of its professionalism is about. And we've seen that therefore in terms of the deal volumes, which is very much held up, and that activity is being across the globe and across different sectors. So I'll drill down into a little bit of what that data has done. We started Global Corporate Venturing back in 2010, and over this past decade, up to the end of 2019, we've seen more corporations effectively become more active each year. That's in terms of having done at least one CVC deal, and that's very much just one of the innovation tools that they could use. Obviously, they could be a customer or supplier or support to some of those entrepreneurs. They might have a sort of venture builder or venture catalyst type of thing or incubator, and often it fits very much with the research and development and mergers and acquisitions activity as part of the strategic innovation tool set. But what we found is, you look through the first 6 months of the year, the sort of right-hand side on the slide, is that actually there was a record number, 187 in the first 3 months, and a further 181 corporations were involved in their first deals ever in that 3-month period. So in the first 6 months of the year, we saw more than 360 corporations engaged in the ecosystem. Now, what we see is some corporations not return, not renew, and not do deals, but that's understandable. Sometimes they will do some deals, wait a couple of quarters, do more. And so it's very hard to take at a short term how many of the established corporations, the 16 or 100 or so that did deals in each in 2018, 2019, were actually engaging or re-engaging, and how many maybe have slowed down as they try to establish what's COVID-19 will mean for their sort of corporate venture in practice. And we'll get to very much the insights from Stéphane, in particular as a CVC, on that point, as well as Paul Holland in a few moments. But I think it's very encouraging that through the downturn, we saw this record number of corporations engaging as first-time investors. Obviously, we very much want them to follow the best practices and professionalism of the established corporate venturing units. But the fact that there's so many coming in, I think, is increasingly important. And what does that mean? When you look at the funding activities, often corporations can do deals directly, setting up their own corporate venturing unit or starting to do deals before setting up a corporate venturing unit, but it also can be a limited partner in venture capital funds as well. And that sort of increasingly intertwined nature of what it means to be an independent VC raising money, perhaps from institutional limited partners as well as from corporate limited partners, and what VCs, particularly the top firms like an NEA or Sequoia, are trying to do to add value to the portfolio companies, increasingly looks like what the best CVCs are doing. They think about the financial returns and how strategically these deals might be relevant to them and how they can add value and support their portfolio companies. And that can be done directly or as a limited partner in the VC funds. And so that level of activity that we're seeing is very much in the first half of the year, like in many ways similar to what we've seen in the sort of prior quarters over the past couple of years and going back before that, obviously. And so in effect, the sort of quick summary is, and again, this is slightly surprising if you go back to the narrative of what was reported in March and April. In fact, I wrote an article myself expecting that there might be sort of 20% fewer deals in the COVID-19 period. So the fact that we've seen the volume of the deals hold up, I think, is really interesting. Obviously, the sort of valuation of those deals in aggregate is slightly lower, and in fact, you could probably say that's the 20%. You know, but the fact that they're sort of held up both in sort of volume and broadly in value, I think is really interesting, and it's very much puts the question that many VCs or many entrepreneurs have had, and again, we'll ask Sukhjinder his perspective on this shortly, but you know, very much from an entrepreneur's perspective, one of the question marks they've had through these past few years has been, if there's a downturn, will the CVC still support? Will they do follow-on deals? Will they still support finding new deals and entrepreneurs? And I think as you look month by month, we've seen this sort of increase coming back. Again, by sort of value and volume, we've not really seen a dramatic drop off in any of those months. In fact, they've actually been slightly higher than in the sort of comparable period, you know, in the final 3 months of 2019. So I think that's a really sort of positive sign coming out of the data. As we look at sort of PitchBook and the NBCA data just for the US, which is a good perspective of how important corporate venturers in particular have been in providing the leadership for those overall venture deals to happen. Obviously, CVCs are just one of many syndicate members. It could be angels, it could be VCs, it could be government investors, you know, as well as, you know, sort of more traditional angels. You know, I think, you know, the fact that corporations have continued to want to do deals and they've been prepared to lead deals has actually meant the overall venture ecosystem has held up perhaps stronger than you would have otherwise expected. Typically, a lot of VCs have been pro-cyclical as well. as the downturns hit, they've been more reluctant to call down money from their limited partners, the institutional limited partners, which sometimes have the denominator effect and not wanting to put capital out the door during a downturn. VCs haven't necessarily wanted to catch a falling knife in terms of doing a deal at a valuation which might then fall dramatically, or in a sector which might then go bankrupt. And so the fact that corporations have still stayed up has actually meant they've reached a record high in terms of their activity. At 53.9% of all venture deals in the US, the world's largest venture market, included a CVC in the first half of the year. And that very much has supported the overall venture ecosystem. So it's not just a question of CVCs being important, reputationally, for entrepreneurs or maintaining their positions in order to support their corporate parent, but actually from an innovation capital ecosystem as a whole, CVCs are very much taking that leadership role and saying to the other syndicate partners, whether VCs or governments or whoever else, that they're prepared to lead. They think the technology will be valuable longer term. They will still be prepared to do these deals, and who wants to join them. And that leadership role is, I think, historically never been held by the CVCs and is increasingly being done so. So again, if you look at the sort of data, and this is one of the things that we were quite interested, thanks to my colleague Kalyan Antonov, who's on this sort of webinar, who runs the GCV analytics team, is that actually the first time deals, i.e. this is a portfolio company or an entrepreneurial company that the CVC hasn't backed before in a prior round, was at a record high. 29% of all deals done in in sort of June, for example, but particularly in the sort of 6-month period, about 20% or more, 20 to 30% of all the deals done that the CVC done were in the first time deal. It wasn't just the question of CVCs backing their existing portfolio companies, providing some bridge financing, supporting them and saying, we're going to retrench from newer deals. Actually, almost a third of deals, between a quarter and a third of deals, were broadly in first time. They were still looking for the entrepreneurs, that could, in effect, bring something new to the table. And we'll talk a little bit more about the shorter to longer term factors that go into that in a little bit. And again, we've not seen much change in terms of the deal size of variations. Obviously, the majority of capital that goes out tends to be in the very large rounds, $100 million to $1 billion size rounds. Think of the tens of billions that have been raised in the ride-hailing sector. Those types of deals raise the most amount of capital, but by volume of deals, it tends to be very much at the smaller sector, particularly those early stage seed A rounds requiring less than 10 million, as well as some of the B, C, D rounds where maybe they got a product and the corporation can help be a customer or supplier, or help with the hiring, or eventually even buy them as well. And again, go back to the sort of activity, the investors, very much it's driven by the big cash-rich technology and financial firms that are looking to drive deals both financially as well as help them think about new areas that they can move into from a strategic point of view. Think about Alphabet through Google Ventures or GV, Capital G, formerly Google Capital, through Gradient and others. Alphabet has a number of different corporate venture units looking in slightly different areas, but they're so cash rich. They're so interested in different areas. If you look at the different sectors, it's not just all in IT. They're also in the health sector. They're also in the financial sector. In fact, they're in almost all sectors, Alphabet alone. Similarly with SoftBank, through its Vision Fund, as well as another asset pools that it has, SoftBank has remained active through the first half of the year in a way that perhaps, given the challenges that were publicized about them as they published their first results in sort of March, April time through the initial crisis, is perhaps a little bit of a surprise, but they've stayed active and they've continued to do deals through the Vision Fund too. Salesforce again, Mitsuho, in which Warren Buffett's just taken a 5% stake, Microsoft, Tencent, SBI, Goldman Sachs, Intel, Samsung, they're all tech, they're all financial. And again, by dollars of rounds that they were involved in, more than 3 billion of rounds Alphabet were involved in as a CVC unit. So again, as you look around the sort of world across different sectors, across different regions, you know, particularly financial services, IT, health, media, US, Asia, particularly active, Europe, quite active in terms of financial services, but fundamentally a little bit of an also ran in sort of other areas as well as the rest of the world. In terms of the sort of deals by sector, you know, again, the IT, health, financial sort of have been driving a lot. The corporate venturers are involved in most sectors and most of the regions. And we'll come to this a little bit with Helen's viewpoint, but we're very honoured and delighted to partner with InnovateUK in the lead up to our first digital forum in June, as well as for the second digital forum, where we'll be focusing as well on transformative industries. But for the first digital forum, we did a partnership, did some report looking at some of the data around some of the healthy aging themes. How does the government think about them? How corporations are involved and active, both from the UK as well as from the rest of the world in those different spaces. So you can really drill down into the data in some of the sectors and subsectors. Obviously, I mentioned GCV Connect. We're honoured and delighted to be partnering with Proceeded, which will be powering their sort of deal management software platform, and they'll be helping run the pitch events so that entrepreneurs that haven't yet been backed by a corporate venturing unit can sort of be judged by some of the CVC members of the Leadership Society, and then be able to pitch. And then we'll show a highlights video at the GCV Digital Forum on the 29th of September. Honoured to partner with Mac49 the day before. They'll be doing some workshops to help CVCs understand and do more in terms of as they think about newer corporate venture programs, how they can scale up and partner. But the main digital forum on the 29th. And we'll also be publishing some initial views from our annual survey. The full results will be coming out in our World of Corporate Venturing report in January. We do our annual conference, the GCVI Summit, at the end of January 28th and 29th of January in California. Obviously, it's COVID willing. It will be a hybrid. We'll do a digital forum alongside if we're able to run the live conference. And that follows our GCV symposium held in London, which will be the 7th and 8th of December, again with a hybrid version. I'll now sort of turn over to Paul Holland, who will be able to share his sort of perspectives, and then we'll sort of run through the introductions from the other panelist members to make sure that we sort of bring out some of the debate. So Paul, do you want to, I'll control the slides, so if you want to say a little bit about yourself and tell me when to move on the slides.
Paul, you have to unmute. There you go. There you go.
I was saying so many good things already, but so thank you, James. Thanks for everybody for participating. My name is Paul Holland. I spent my operating career helping to start 2 software companies with friends. One was a company called Pure Software with Reed Hastings. Reed just published a big book this morning for those of you who are on the blogosphere on Netflix corporate culture, which is really, really cool. It's a topic that he's been passionate about for the 33 years that I've known him. And then after Pure Software, which went to about $2.5 billion in market cap, I joined Kana Communications at the request of Andy Ratcliffe, who founded Benchmark Capital. Kana went from 13 million to 9 billion when I was there as the #2 exec and running the global commercial business. I then got recruited over to Foundation Capital. I spent 18 years there as a general partner. Foundation's a very good firm, top tier firm. We've invested about $3.5 billion of investor capital, and so far created about $350 billion of market capitalization. Netflix is a good chunk of that, but we have 28 other IPOs, including companies like Chegg and Mobile Iron and Sunrun and many others. I started advising Mach49 a few years ago, and then have joined them full time last year as the managing director of corporate investing, and we'll spend some time on that. So next slide, please. Yeah, there we go. So, you know, when we first got the call about this webinar, it was really on the concept of like, okay, what's different about COVID? And so the metaphor that we're using, we're borrowing from Warren Buffett, which is this notion of being bold when others are fearful. And Jim already touched on this many times, that, you know, historically corporations sort of, you know, fold their tents when the economy goes bad. But this is a time that there's an opportunity to really do the opposite, which is what great investors do. Next slide. And so we think this is actually probably one of the best times in any of our careers to be in a position to disrupt markets and to create these new ventures. And I'm going to describe two different forms in which we help people do that at Mach 49. One is to help start corporate venture groups, and the other is to help start new ventures and incubators. So let's go to the next slide. And this is the behavior that we're really trying to warn people against. And I've got some statistics to kind of back this up. You know, oftentimes you get a macro shock like we've seen here. This was the biggest macro shock any of us have ever seen. And what happens is people begin to run for the exits. They exit, they divest, they get out of what they're doing. And now the reality is it's actually the best time to enter these markets and to start a CVC and make these investments and start these new businesses is during a downturn, as evidenced by the statistics that we'll cite next. So next slide. So here on this graphic, we're borrowing from our friends at Correlation Ventures, Trevor Kienzle, and they put together this very nice piece, just looking over the last 20 years, but this data holds over the last 50 or 60 years. I've seen it in different forms. And if you look at a big macro shock, for example, the dot-com collapse and the 9/11 terrorist attacks, you see the market get hammered. However, the people who entered the market in that time period, they enjoyed a tremendous upside over the course of the next business cycle. And then once again in 2008, we saw a down cycle occur, but the people who stayed in the pocket and continued to invest enjoyed a tremendous upcycle and returns as a result of that. Next slide. And then more specifically, if you look at the actual data itself, people will tend to think, you know, as markets are getting heated and very frothy, they're like, oh, I want to get into venture capital. I want to get into a startup. And that's what people felt like back in, you know, early 1999, mid 1999, early 2000. Yeah, I really want to get in a startup. But look at the vintage returns there, the 0.89, negative 0.89 and the 0.73. Those are the returns of the people who were in a position where they tried to enter the market at the very top. So those vintages were actually terrible. But go back in time a little bit. Recession in the end of 1990, 1991 time period, very tough recession. The people who were invested out of that recession and began to see the results of it in 95, 96 had spectacular results that occurred over time. Jump down to the bottom and you look at 2008, very quick downturn, began to start to see the recovery. The vintages from that time period are showing some terrific results, and then even better going forward. Next up. And so this is what we mean by Warren Buffett's kind of analogy here. You know, you've got to charge when other people are retreating. We think there's no better time for the dinosaurs to eat the unicorns in this case. We think large companies have the talent, the ideas, the brand, and they have channels and they have customers, and you're going to hear about that as we hear from the two cases today. Next up. And there's no better, there's no reason why over time a Blockbuster couldn't have started a Netflix, or a Marriott couldn't have started an Airbnb, or that Stripe, which is now 32 billion in market cap, couldn't have been started by any of the large banks in the world. The difference is that they needed that sort of Silicon Valley innovation culture, and that's where Mach 49 comes in. Next up. And so if we look at what's happened just over the course of the last 6 months, you know, some of these are really well chronicled. Others are stories that people don't know quite as well. Zoom, DoorDash, Peloton, these companies have absolutely boomed. Netflix has gone through the roof. But other companies you may not know as well. WaveXR. WaveXR is a portfolio company of Convivialité Ventures you're going to be hearing from soon. They've built the first really viable digital virtual concert platform. So they held a concert with John Legend over a 24-hour period. They had 500,000 people. They had the weekend. They had 2 million people attend the concert. So this is a new model. This is going to be an explosive model, and who knows when we're going to get to go back to live concerts. Companies like Chegg, one of my portfolio companies in digital education. Market cap went from 500 million to 11 billion over a quick period of about 4 years, and it's accelerated really rapidly during the COVID crisis. And then companies like OutSchool, where sales have increased by 2,000% as people are taking their schooling online. Next up. And it's not just simply the startups. It's not the companies that you're hearing about, the unicorns and so forth. It's the large companies that are leaning in here. TDK, Nicolas Savage, who's one of our really premier clients, who I think is actually attending today. They've started a corporate venture group less than 18 months ago. They've done a terrific job. They've got a number of new ventures underway, very exciting new initiatives for their company. Companies like Intel have redone their incubators using Mach 49, starting over a dozen new companies using the format. Pernod Ricard, we're going to hear from directly with Stéphane soon, and some of the other examples that are here. Next up. And so how are these companies winning in this environment? Next, please. Well, they're building a pipeline and portfolio of new ventures. And I know this is something Jim would back me up on, but over and over again, when we get inside large companies, we see a phenomenon where they have too few shots on goal. They have too few chances at creating a portfolio effect. If you look at a Foundation Capital, we've had 250 portfolio companies over a 25-year period. Now, as it turns out, 5 of those companies have generated more than 2/3 of the returns of the portfolio. But guess what? We didn't know which one of those were going to do that, right? Until we did the company, and then they matriculated and they grew. So large companies need to dedicate themselves to generating a pipeline and portfolio of new ventures. Next, please. And there are 4 ways that we can help people do that. 1, to launch ventures. And you're going to hear Sukhjinder Singh describe that process at Pear.AI for RWE. 2, we can help build an incubator. We've done that now with Schneider Electric, Intel, Stanley Black & Decker, Pricewaterhouse, and others. 3rd way is through corporate venturing. Stéphane's going to talk us through that. And then finally, an overarching message is really bringing the Silicon Valley inside. Finding a way to take all those corporate functions that are today that are pretty sclerotic and resistant and making them more nimble and more agile. Next, please. So these are the 2 cases that we're going to go over today. I'm going to bounce on each of these, and then I'm going to introduce Stéphane and then introduce Sukhjinder, and they'll go into much more detail. So this is a relationship that we've had with Pernod Ricard now for the last few years. It's been a terrific relationship for us. So in the case of Pernod Ricard, one of the very top spirits and wines companies in the world, you know them less through their parent name, except through their product names: Absolute Vodka, Jameson Whiskey, Mumm Champagne, and others. So really, really top company, 10 billion in revenue in a $300 billion worldwide market. Well, what Alex Ricard, the CEO, wanted to do, and what he asked Stéphane to come from his role to come to America to do in Silicon Valley, is to really move from the core of wine and spirits to begin to explore kind of these brave new worlds, right? And really, this is moving to what we would call kind of the experiential economy: entertainment, hospitality, tourism, and other areas. So going from a $300 billion market to a $3 trillion market, and using this metaphor of Convivialité ventures, which Stéphane will explain to us in a moment, as a way to be able to do that. I do have to give you a little bit of a kind of a humorous interstitial here. So we love this slide, and we've actually used it for a number of different clients. We used it for TDK, and when Nicolas Savage got in front of Ishihiro-san, the CEO of TDK, he stopped and he said, "Why is the astronaut drinking a beer? That would be very dangerous to drink a beer. Plus, with 0 gravity, the beer would just float out." And we said, we forgot to take the beer out for a TDK. But at any rate, then you get the idea. Next up. And now from the other part of our business, one part we call Disrupting Outside In, helping people build these corporate venture groups like you're going to hear about from Stéphane. And then the other part is to help generate these new businesses, new startups inside large companies, typically using the people from the company. And that the canonical example for us is a company called Pear.AI. And in a few minutes, you're going to hear from the CEO, Sukhjinder Singh, and he'll talk you through the whole experience from the incubate, accelerate, and all the way through scale. And in fact, in this case, the relatively new news is the company has already exited. So it's a pretty exciting story all around. Next, please. So as we started the conversation, it's either the worst of times or the best of times. You know, the choice is yours. And we think that it's time to really put the pedal down and move forward. The world is moving. I was on CNBC a couple of weeks ago, and I got a question about kind of what's going on the macro. And I said 2 words: digital and virtual. The world is moving to digital and virtual, and it's happening overnight. The choice is yours. We think it's time to move forward. Next, please. Great. So with that, I'm going to move off the stage and then turn this over to my friend Stéphane Longuet. I was introduced to Stéphane through the relationship that we'd begun with the C-suite at Pernod Ricard. At the time, Stéphane was the CFO of Absolut Vodka, living in Sweden, living his best life in Stockholm. And then he was asked to come to San Francisco to start this new entity, a venture firm for Pernod Ricard, which later we ended up branding as Convivialité Ventures. So I'm going to turn it over to Stéphane so you can hear that story.
Thanks, Paul. Can you hear me?
Yes.
Perfect.
Okay, great. So many thanks for the introduction, Paul. So I'm Stéphane Longuet. As you can hear, I'm French, and I'm in charge of Convivialité Venture that we created here in San Francisco 3 years ago. You are so a bit familiar with our brands that Paul mentioned, and you can see behind me, in our bar. And so we have one of the broadest portfolio of alcohol, wine, and spirits that you can find. And this is our core business. But we have a vision that is broader than this. The group vision is creator of conviviality. So basically bringing people together so that they can have great time anywhere, anytime. And this is much broader than saying we are creator of great wine and spirits. So this is why our group CEO asked me a bit more than 3 years ago now to create Convivialité Ventures, so our corporate venture arm. And the main purpose is to invest in new business model beyond our core business, which is alcohol, and more specifically in services and experiences that are in that space that we call conviviality. And that covers, as we could see a bit on the previous chart showed by Paul, different new business, like for us at least, like hospitality, entertainment, or retail. So the purpose of Convivialité Venture is to discover a new business model in that different spaces that are adjacent to our core business, but new for us, so that we can learn and over time invest more money in the most promising spaces in a way or another, either through the venture fund or even including creating new business or acquiring new business in these spaces that could be logical extension of Pernod Ricard business. So we started in the Silicon Valley. Why? Because this is the biggest innovation ecosystem in the world. So you need to start from somewhere. We wanted to start in the US because US is our biggest market for Pernod Ricard. And in the Silicon Valley, due to the dynamism of the innovation, even if the purpose is to invest not only in the US, but also in other promising innovation ecosystem. And then I met with Paul 3 years ago and we started to partner together. He has been our coach and mentor and shadow partner, basically teaching us how to become an investor in the Silicon Valley, how to create a corporate venture fund from scratch. I don't have any investment background. You know, I've been working for Pernod Ricard for more than 20 years now. So I'm a company veteran at different roles as a CFO originally in market or in the Absolut company after the acquisition. I run some business units in charge of global portfolio of brands. So focus on marketing, production, and commercial. So I had no background in investment. So I had to learn how to become an investor. And it was possible thanks to Paul and his experience. So, but being an investor or a smart investor or a good investor is not enough if you want to build a corporate venture fund. You need also many other stuff. You know, you need to connect also what you are doing with the mothership, with your corporate colleagues, so that you can really create the strategic value, which is the second purpose beyond making great investment. Is one of the main purposes is to create strategic value for your corporate, but also for the startup and your portfolio startup in which you invest in. So we have, two strategic objectives. One is long-term, is the one I described before originally, is to discover and learn about, promising new business. And this is looking at the future. Another one is more short-term, is really to partner with the startups and to be helpful with the portfolio and to help them to grow, and vice versa, to bring back into our ecosystem, into the corporate, the innovation piece that the startup are creating to help to transform the corporate. In terms of stage, we are pretty agnostic. We invest not too early, not too late. So we start from Series A until later stage. We follow on with our winners and the most interesting company strategically for us. And we invest across different areas. As mentioned before, you can see that on our website. So far, we have invested in 12 companies in the US, Europe, but also China. We have team also now in Europe and in China. We cover the 3 main innovation ecosystem that are interesting and relevant for us. And we try to create some strategic value. So I would like to give you 3 examples of portfolio company and what we are doing with them. The first one is called Glovo. It's a company based in Europe, in Spain, but operating in Europe, LATAM, and Middle East and Africa. It's on-demand delivery of anything you need. And so can you see me because I see a comment? Yeah.
No, you're fine.
Okay. All right. So so Glovo is a on-demand delivery of anything you need, like Postmates in the US, and not only meal delivery, but groceries, pharmacy, and so on. And with them, we want to help them to co-create and develop the alcohol and party on-demand delivery in 20 minutes. We have a good coverage in 80 countries, and we help them to grow anywhere they go. The second one is called Fever. They want to be the Netflix for experience. So they create in real life amazing experience themselves. They promote it and market it through their app and media. They act also for third-party experience. And their secret sauce is that they are extremely data-driven. And this is, and hence they know exactly what consumer wants. So with them, we partner to really transform the way we create events with our brand from being too much brand-centric into being consumer-centric and leveraging all their secret sauce and platform to create amazing experience for consumers. And the last example I would like to give is a company called Zola. It's based in US, in New York, and it's a go-to platform for wedding. So you can find anything you need to organize your wedding, from creating a website to sending invites, building a registry, or creating the event and the wedding itself. And wedding is a huge alcohol consumption also opportunity, but not only the wedding, pre-wedding, post-wedding, and so on. And with them, we want to help them to co-build and create their product, adding our insight experience to create amazing experience where alcohol and our brands can be present. So these are the 3 examples of portfolio company and what we want to do with them. Now, James, before our conversation, asked me to think about what are the trends that we have been seeing over the last 6 months and changes through COVID. And I try to summarize a few that we have been seeing among others. The first one, I would say, is there were some mega trends that were existing pre-COVID that have been reinforced through the COVID and even more relevant. The first one I mentioned before with Glovo, on-demand delivery. That was already a mega trend, but during lockdown, that was the only way to get, food, grocery, or any supply you need for some people. And then they've seen their business booming because recruiting new consumer that really needed this service and solving a big pain point. The second one, as an example, is there has been a trend for local travel, because of the restriction for international travel. People have been traveling locally, close to their home during the summer. And we have seen that with one of our portfolio company called AvantStay, which is an operator for group travel. They rent basically big houses and they operate them as hotel with very high standards. and you can have any type of experience with your friend and family. And they have been, doing extremely well during and post-COVID. So trends have been reinforced. Second, there has been clearly a need for virtual entertainment. Our investment thesis is we want to bring people together in the real life, and we still think it's a fundamental human need to bring people in the real life that will stay forever. However, when you have such constraint as lockdowns, people still want to interact. And I guess most of you have been in a Zoom party organized by your friends or whoever, but we have seen businesses really develop around this among our portfolio company, mentioning Fever, whose purpose was to, and is still, to organize in real life experience. They have been organizing virtual events on Zoom where people were ready to pay because it was really curated and very specific and original that, it drove people attention. We have been working with them to create, cocktail classes online with bartender, and people have been paying for it, getting delivered the drinks before the tasting. Third point I would like to make, some emerging trends that we could see have been reinforced, and notably the influence of gaming into the culture and the gaming technology into the entertainment world. Paul mentioned Wave. That's the best example of this. Wave create live interactive concert and shows with artists in the real time, but leveraging the virtual world and the gaming technology, which allows them to magnify the event and also make it really interactive, and for the artists to reach live millions of consumers. So we have been seeing that as a big trend and reinforced, got the traction from many investors. And this is the last investment we did during the COVID. And of course, on the negative side, many businesses have been, all the businesses have been impacted. The most negatively one have been around corporate events and travel due to the restrictions. But even in tough time, the startup, they find ways to be creative. And I would like to mention one of our portfolio company called Pear.AI, who is a marketplace, which is a marketplace to organize any type of events, private or corporate. Corporate events, of course, have been reduced almost to nothing, but a part of their business was to use spaces to produce digital assets for the online, which has been reinforced and has helped the company to survive during the crisis and even to do better than pre-COVID. So these are a few examples of the trend we have been seeing. Overall, the message I would like to give is there are plenty of opportunities during this COVID period. And I think our deal flow has been even more important than before COVID. We have been very selective in our investment. We have follow-on in our base company. We have made some new investments. But in this period, there is even more the need to innovate and solve pain points that are even more clear. And that offers so many opportunities for investor and corporate investor like us.
Okay, well, thank you for that, Stéphane. And as Paul very wisely said, you've been very much interested in sort of an example in that regard in terms of showing some of the sort of trends. And I think it'd be great to hear the view from more the entrepreneurial perspective with Sukhjinder, if you're able to sort of join and sort of give the perspective from an entrepreneur. And obviously, congratulations on your sort of exit, and be interested to see your views on what it's like being part of the mothership now.
Thank you very much, Jim. Paul, no introduction for me? Yeah.
I didn't want to, I didn't want to bog people down. Anyway, Sukhjinder's a pretty good guy. He's an okay executive. He drinks a lot of champagne. No. So we have a model at Mach 49 in terms of how we incubate these startups. So we get engaged with large companies. In this case, we were approached by Patrick Lammers and team at RWE Energy. They had an idea, and then they had a team led by Sukhjinder, who's got a terrific background that I'm going to let him explain himself. And they came to Mach 49 to the Silicon Valley from Europe, and so some of the folks from here, and they started working on their original idea. And Mach 49's process, which is going to be featured in a book coming out from Harvard in the spring, Disrupting Inside Out by Linda Yates, our founder and CEO. The process basically involves a very, very intense 12-week incubation period. And in the first 4 or 5 weeks of that, you're going to speak to between 100 and 200 customers. So it's a very, very rigorous model. So Sukhjinder was leading his team on this. The group was working on it. They came back to Linda and said, you know, we must be doing something wrong because nobody wants what we're trying to sell. And she said, no, you're doing something right. Let's kill that idea. Are you hearing anything interesting that's different than what your original idea was that you went to market to test? And then now with that, I'll introduce Sukhjinder because he can take the story from there.
Good. Thank you very much, Paul. Thanks for the introduction. And good afternoon, good morning, everybody else. You're right, you know, Paul. It was an exciting journey. And just to go back 3 years and just a little bit more of flavor. Oh, so let me introduce myself. Sukhjinder Singh. Maybe you heard from my accent. You know, it's really Dutch. So I'm from the Netherlands. Moved over to California because, you know, this is where, you know, technology happens, and really excited to being here and still here to, you know, to really learn how to, you know, disrupt. I think that is the right word, which I learned here in Silicon Valley. But now going back to Pear.AI. So 3 years ago, RWE, one of the biggest, you know, utilities in Europe, they said, you know, we want to innovate. It was one of those things 3-4 years ago with big corporates said, we're going to do innovation. And what they actually did is, in their perception, innovation was, we're going to send a couple of people, you know, to Silicon Valley, to Berlin, to Israel, and they're going to sit there and then invest. That's what they thought about innovation. They're going to look for companies and then hang around and do things and maybe find a company where they, but there was no idea and there was no thought process whatsoever about it. And then, like Paul said, you know, then Patrick Lammers came around and said, listen, what we should really be doing is, if it's innovating, we should create a company. And this is where Mark 49, Patrick had that idea, but he struggled to see how do you need to sell it within his corporate, until he met Linda and Paul and said, listen, guys, this is my idea. And this is where we found each other. RWE found Mark 49 and said, okay, we're going to do something totally different, that is create a company. And the way we started is just to, you know, just to brainstorm, you know, we call it the Blitz, you know, Mark 49 call it the Blitz, where we came all together and we said, okay, what is the idea we're going to do? And there was no predefined, you know, idea. It wasn't even a market. Are we going to do commercial, or is it going to be, you know, retail side? Is it going to be in the energy space itself? It was just, it was open-minded to look how we could really disrupt the market. And this is what I loved it, because we have people within the Blitz, which were, I think, 67 people. And I think only 25% of the people had an energy background. And that made it already so interesting. How are you going to look at opportunities? And we came out with, you know, a couple of ideas we thought, you know, that could work, and one specific one. And then the process was really to investigate. So we had hundreds of interviews, and this is where I personally learned synthesizing, because you phone customers, you pitch your idea, and what does a customer say? And when it comes back, you need to synthesize that. Not only what that customer said, but what all those potential customers said. And based on that, you come to conclusions. And what I liked is that the idea we initially had, we synthesized it with all this, and we said, nah, nobody wants that. It's not there. And what I liked is that we said that, and you know what you will see within just big corporates, because you're doing a project, let's continue, let's find something, let's maybe fit it in something we can justify it. No, well, we said, drop it. So we dropped it. And we thought, well, what did we hear from customers? And based on that one, what we did hear is what they wanted to have in the energy space is something where they wanted to be helped. They really wanted a company which on their behalf could solve things for them. And that's why we created Pear.AI. And then what happened is, you know, we pivoted, as we call it over here, we pivoted. And then what we did is we focused on the problem statement we heard from the customers. We pivoted to that one. We did more customers interviewed. And then what we did is we created a proof of concept. We said, this is the proof of concept, which, you know, we're going to test again with, you know, some customers which were receptive to the initial idea. And once we did that, you know, we got very positive feedback. And based on that feedback, we did a report out. So together with Mark 49, we did a presentation for the board of RWE and said, listen, in 12 weeks, this is what we've done. And this is what, you know, we believe we should be doing. And I still remember one of the first questions, because it's the board of RWE sitting over there. And one of the first questions was asked is, Sukhjinder, why do you think we should do this? Why do you? Because we heard your customer story, we heard this. And I told them, listen, I would invest in it. I, as an entrepreneur, would really invest in this idea. And that has made, I think, also a very nice way where RWE found, you know, outside of their normal corporate structure, set up a startup with people which are also dedicated, and they had skin in the game and they believed in it. And that's what we did. So RWE, you know, funded the startup. You know, we accelerated. It went successful. We created the product. And, you know, and more customers came into the platform, and, you know, we further developed it. And then the other, you know, important thing to tell also is that, you know, you just heard we did an exit. So why did we do an exit? And this is, again, where I think it's very important that you talk with, you're a startup, and RWE invested in it, and also being honest against your investor. So while we were being successful, another company came around and they said, listen, we love this so great. We would like to do it for all our customers in the US, because we think this is going to really disrupt the way we do business. And it was in the energy space, not the most sexy space, let's be honest, but it is what they believed into it. And then my discussion with RWE was, listen, guys, there are two opportunities. You can continue with this, or we can, you know, we can exit it, because this is a company, and I think they will be able to really accelerate it in the US. And due to RWE was in negotiations to have a merger, so a lot of things were going on. And what I liked also is that RWE said, you know, looking at everything which is going on and what is happening, we believe that this company would be better suited, you know, with this new, let's say, with this new mother. And that's what happened. And I think there was a very honest, open discussion between the entrepreneurs on one side, which was the startup, and the corporate on that side. And together we came together, when we came together, we said, okay, we just need to, the best for both parties is to exit it. And that's what we did this year. What also happened is for RWE, they also had a proof point, because we went full circle. They created something, and, you know, we started up, it was successful. And then, you know, we exited it, because that is also one of the ideas you as a corporate venture could see is, you know, maybe it's better to exit it and get the money and put it somewhere else. And that's what RWE did now. They took that money and they're going to put it in somewhere else, what they want to do in Europe at the moment. So that is, I think, you know, the story from Pear.AI, and it was a fantastic journey for both parties. A little bit now on, you know, Jim, what you also said, and I think that's interesting. What is happening now with this trend in this industry itself? You know, we see much more investments. And as an entrepreneur, I must be honest, in the last 6 months, I've never had so many people want to have a chat. And they said, hey, Sukhjinder, we need to chat. And Stéphane, you did the great, you know, overview about the trends you see on macro level, you know, about being virtual, you know. I had the companies which were in the purification business because of COVID. They said, hey, Sukhjinder, we need to do something there, because everything needs to be now, you know, purified. You know, it could be machines or it could be rooms. We see health. So besides those macros, what I've seen more on a behavioral trends when I'm talking with these large corporates is 3 elements. And one I've seen is that companies see, hey, organic growth, because of COVID and all the things were happening, we see that organic growth is getting maybe more of an issue because of, you know, the downturn economy. So what can we do differently to really get maybe new ways to start making money? And this is where they have been talking about Sukhjinder. What are the ideas? Can we ideate? Can we look at new opportunities for us, not only for now, but for the coming years? So that is one of the things I've seen. The second thing is also is that, and this virtual working, it seems like, and especially what I've seen now with senior managers, is that it seems they have more time to talk about strategy. They really are taking the time now. They say, okay, hey guys, we really need to rethink it. And because maybe there is less traveling going on, I have more meetings where they want to have these strategic sessions. and look at these strategic sanctions and really say, okay, what do we want to do? Where do we want to go? So that is the second thing I've seen. And the third one, which I saw is that when they have to make, let's say, decisions about, the things they want to do, they have internally a lot of projects going on, a lot of projects. And then externally, what they can do is like investing in a startup. It seems that they are feeling that, that is the way to go, because an internal project doesn't have that momentum. So they're easier to say, an internal project, let's slash it, because we're not getting that traction, or it's going on for 3 years. There is no way to do it. So you know what? Let's stop that. Let's stop those, projects which have been going on for 3 years, and let's do something different. And that is where I also have seen is much more interest in investing in startup, because there is something different, and they are taking the decisions to, especially internally, do less projects or slash them, because, hey, it's going nowhere. But anyway, that is another thing, Jim, to add to it, what I've seen, really on a behavioral trend, why I think there are more, investments going on.
Wonderful. Well, there's fascinating insights, and congratulations again, Sukhjinder. It's impressive to get the exit in such a rapid piece of time as well. So
yep.
I think we'll come more in the sort of in the open sort of Q&A. Just a reminder to the attendees that to use the sort of chat or Q&A function if you want to ask questions. But before we get to that part, I'll invite Helen from InnovateUK to kind of provide a little bit of her background and very much talk through from the macro point of view how governments are thinking of supporting the innovation ecosystem, and perhaps a call out for some of the challenges you're working on currently. Helen.
Thanks very much, James, and I don't really know how to follow that. That was really inspiring, thank you, and thanks to all the speakers today. So my name's Helen Crampin, and I'm one of the innovation leads working for InnovateUK. For those of you who don't know who we are the government's UK innovation agency, and our aim is to fund businesses, research collaborations in all economic sectors and across all UK regions to drive and accelerate innovation. To that end, we have a series of challenges, a series of grand challenges, as they're called, set out by the Industrial Strategy Challenge Fund. And there's 4 of them: AI, data economy, clean growth, future of mobility, and the one that I actually work under is the aging society. There are a further 23 lesser challenges that come under those grand challenges, and I'm not going to list all of those because we'll just run out of time and you don't want to hear them. So the strategy that was set out by using these challenges is that we look at each challenge separately, and underneath those challenges we have a set of themes that we then focus in on. So to talk about the Aging Society Grand Challenge, we've got 7 themes that sit under that Grand Challenge, and they go from social isolation to managing common complex of aging to environment, housing, just to give you a taste of the fact that the aging challenge is actually quite unique in that it's not that specific, and we cover quite a wide area and quite a number of sectors. So each challenge has different funding strategies and different ways to fund businesses. And one of the funding strategies that we're currently not piloting, because it's been going for a couple of years now, but we're piloting it in a much bigger way, is the investment partnership scheme. So what that involves is we are partnering with investors to deliver the funding. So we give the investors a certain amount of funding, and they align with private equity to that amount of funding to cover project costs and any other additional costs. Above and beyond, we ask for 2 times at the moment that amount, but it does vary from project to project. And those investors also commit to funding those startups further down the line. So this isn't just over the 2-year project time. They should commit to fund further obviously if the project is successful. So the investors I'm currently working with are Barclays, Legal & General and North Star. So they are all very, very different types of investors. And I really want to make sure I mention the fact that we have round 1, which is that was to attract those investors. So the call is now open for SMEs who are working on healthy aging products that we're interested in, to approach those investors and start engaging with those investors to then apply for funding. Round 2 has just opened, and this is, again, we are looking for between 2 to 4 investors to, again, provide private equity alongside the grant funding that we will allocate. Again, it's got to be looking at one of those themes of healthy aging. We're looking for different types of investors, so not just your traditional commercial investor. We are very interested in impact investors and charities and social enterprise. So this is something that this is one of the challenges within our challenge, shall we say, because there is not the appetite from traditional venture capitalists to invest in social enterprise. But one of the big challenges, one of the big things we are trying to address is narrowing the gap between the richest and poorest, really addressing social inequalities. And just to touch on COVID, I have never, again, as everyone has said, I have never been busier at work. One of the things COVID has done is really show how bad the gap between the rich and poor are, how many social inequalities are out there, and actually how a certain population of people do not get what they need. So, you know, we are very, very busy as a challenge. And you know, we went from thinking maybe investors were not going to be quite as interested in engaging with us to actually being the opposite. You know, investors are very, very interested to engage with us because all of the issues around healthy aging have been catapulted into the spotlight. However, the sort of SMEs that we're talking about there are your telehealth, your apps, your AI, your VR, the really high tech kind of solutions. What we really need to do, and where there is a gap, is in social enterprise, is really trying to deliver solutions to address the issues for people that don't have the money to be able to afford these really nice bits of tech. So to that end, we are trying to attract maybe investors that have impact at the heart of what they do. And that is actually a challenge. And that's one of the challenges that I'm finding within the Healthy Aging Challenge. But I hope it's something that COVID has maybe given investors the time to think about, and actually, you know, they should be investing in this area, and they should be investing more into social enterprise. It's just how we create a funding model that works for both sides. I think I'll end there, Jim, so we can get to the Q&A if that's all right.
Yeah, perfect, Helen, and that's a perfect segue because obviously this is a preview to the GCV Digital Forum on the 29th, and everyone's joining that program. But the impact investing or sustainable development goals is one of the key streams of themes we have, where Sir Ronald Cohen, who's chairman of the global steering group around sort of impact investing, will be talking, along with George Seraphim, who's a professor at Harvard Business School, who's developing the impact accounting standard. So all corporations effectively will start to be judged under GAP principles, but also looking at how their sort of net zero or their sustainability metrics will impact their financials. So it's a powerful piece of work that George will be talking about there. But if I could take that sort of that opening theme that you had, Helen, which is, you know, this idea of inequality, you know, it seems to fit very much with what Stéphane was talking about, which is this idea that they were going from sort of food and beverages, drinks, fundamentally towards the experiential economy. And how does that fit with what people are doing and how they're living healthily? And I'm just wondering whether, and also obviously from Sukhjinder's viewpoint around, you know, obviously having a large energy company, trying to help them set up and do some initiative. I'm just wondering, from all four of you as sort of discussions, how much this idea of what will be an important trend from an entrepreneur to think of, an investor to find, a government to support, or obviously from Mac 49 across the different companies, how important it is to think around that more holistic principle of sustainability, either as identifying opportunities or finding something that's going to motivate the team. And so be interested if there are different views, Stéphane, Sukhjinder, or Helen, as well as Paul, if you want to sort of kick off with that broader perspective on that sustainability issue.
I can start if you want.
Please, Stéphane.
On our corporate social responsibility, we have a corporate policy, and very detailed to support any sustainable or social responsibility around consumption of products. So when we invest in startup, this is an important parameter. We look at the impact of the startup on the environment or socially. So, and if we don't feel comfortable, we don't invest. That's one. Then more specifically on new business that can come to solve some problem around our industry. There is clearly the topic of future of packaging, which is fundamental for all the CPG company. Everybody's trying to get rid of plastic, which is great. In our industry, we don't use plastic so much. We use more glass, but what is the future of glass too? So these are things that we are looking at, and we start to look at, and we think it's part of our responsibility to play a role there. So any entrepreneur who has an interesting idea around future of packaging to put liquid in innovative type of pack is really interesting to us.
Mm-hmm. Sukhjinder, how much did this kind of come back as an issue when you were doing the 12-week sort of cycle of getting feedback?
No, that's a great point, Jim. And I think this is one of the pivots we did at that time. So I think there are two elements for me. If I look at this at this level, it's really about sustainability. So one of the things I think is what we see is customers are asking for it. You see customers, as we really look in the energy market, customers are demanding from the big energy providers, like, I want a sustainable product. What are you going to do to really help me make me sustainable? And that's where we played a role into, because that's what we heard from customers. That's what when we did that also is that, and we created Pear.AI to really, have the data and to be able to play a role in the sustainability space. And it started with having the data. And this is also the acquisitions which was done, in a couple of months ago, is really to take this company Pear.AI and then also turn it into to provide solutions for company to be more sustainable. And that is what I'm seeing. So I do see energy companies, but I see it on a broader level, not just on a company level. I see companies are becoming much more sustainable, but what I see much more is also there is like a pull from customers and demanding, what are you doing for me? How are you going to help me to become sustainable? And it's not just like in the energy market, I'm giving you, green energy. It is also, look, I want to retrofit my retail store because I want to be sustainable. What are you going to do with me? And just one thing very specific, what I've seen is in this whole sustainability, energy, but also in the manufacturing space, is that how can you, visualize what it means, sustainability? What does it mean for me? What are the means where you as a provider can show me, is it a saving of energy, or is it a saving of money? Is it more, like we say, in material that people feel better, or are we making it a better place for this world? So really helping them also to identify what it means. So that is what I'm seeing. I'm really seeing a push from let's say the energy company, but I see much bigger a pull from customers.
That's really interesting. And Paul, from Mac49, obviously, I think you've got new clients and people like Halliburton and others. So, as you think about your whole sort of roster, what are the corporate client, responding to, and, what do they seem to need help with? Is it around the ESG or sustainability, or is it in other areas? Is there, other sort of trends you can pull out?
Well, I think so. Thank you, and thank you for our friends at Halliburton, who we met through Jim and through GCV. So, I would say one of our biggest sectors of our business are working with people, broadly speaking, in the energy world. We have many clients. If you mention the names, you'd recognize all of them. And in nearly every case, they're working on ways to get more into renewable and more into sustainability. It's the growth opportunity for them. For many of the oil companies, they have sort of a quite literally drop dead date of 2060, that by which time they don't think they're going to have a viable business anymore, kind of bringing oil out of the ground. So they need to transform themselves into something else. And so we're seeing that trend line. We're also seeing another trend line that's showing up quite immediately, actually, where family offices in various forms, family offices in the forms of PE firms or family offices that are adjuncts of larger companies. These family offices are like corporations, but they're much more intimate and direct. They're made up of people. They're made up of the family members who are driving strategy around the investments. And many of those family members, particularly younger family members, I have 3 daughters in college, their top priority and the way they think about things is around sustainability. They don't, and everything else kind of falls lower on the list. And so as you interact with some of these family offices, they have very significant initiatives around ESG in one form or another. And then the final note I'll make, and you guys probably all saw this, but over the weekend, Fortune did a piece on the big European initiative. This discussion about $40 trillion of capital is moving towards, pieces of that are now moving towards more sustainability, more ESG related goals from an investment perspective. So I think that, I used to run the clean tech practice at Foundation starting back in 2004 timeframe, and I would describe that as sort of wave 1.0 on this phenomenon around investing. And then, of course, we had the hype cycle broke. People kind of ran out of the building, didn't want to do it anymore. And now what we're going to see, I think, is a much bigger wave that's going to happen this time around. And it'll be quite real because it's backed up by actually business imperatives and consumer demand.
Okay, excellent. We've got some questions coming in. Greg Watson, Lincoln Partnership Capital, asking a follow-up question perhaps for Stéphane, which is what impact, if any, is the rise of ESG investment activity by large investors having on CVC activity and wider innovation partnering by large corporations? I think you touched on this with your earlier thoughts, Stéphane, but are you finding that sort of bigger picture, as Paul would say, the sort of the large asset managers saying to effectively as a shareholder in Pernod Ricard and others, what are you doing to this, and is that driving then that sort of CVC activity? Is it coming very much from the top down, or are you seeing the bottom up entrepreneurs coming to you and say, we want to solve this challenge, can you help us?
We don't see it from the top down as strong. I mean, there is a clear group policy to improve, our social responsibility, our footprint we have on the planet, and every year you can see the KPIs at corporate level. It's improving, and it's great. In our role as CVC, we think we have a role to play. It was not part of our original investment thesis, where we're looking for B2C business, new business model in our space around hospitality, entertainment or retail. But we feel in the team first that it's our role, and also it's supported by our investment committee, that we should look also at innovative technology that are going to change the future. We believe it's our role to think ahead, 5 years, 10 years ahead, what is going to happen, and have a positive impact on the planet. So we are adding that to our thesis, even if it was not originally part of it, but we feel it's pretty natural to have it here.
Excellent. And perhaps a follow-up question, Helen, for you, in terms of, again, from a government point of view, if you're encouraging that social sort of focus on inequality or other areas, broadly within the European Commission as well, how do you see investors, entrepreneurs, maybe with academia, universities coming together? Is the government role very much to provide a little bit of funding and convening power? What are you trying to mold as this ecosystem?
Yeah, I think, convening is a really good word, actually. And something that we are doing, or I am doing quite a lot of at the moment, is working with accelerators. So there's, just to give an example, as an accelerator in Sheffield, here in Sheffield, the Advanced Wellbeing Research Accelerator, and it's funded and run in conjunction with a number of partners: the University of Sheffield, Hallam, the Hallam University, Canon, Amazon. There's some big investors that are involved with this, but what they're doing is bringing together universities, SMEs, and then the mentors across a whole range of businesses, a whole range of sectors, and it's a really successful model. There's over 64, and it's only recently started, and they already have over 64 businesses within the accelerator. And just by bringing together all the different stakeholders, it's just pushing those SMEs further than they would have done if they hadn't had all of the different involvements from those different sectors. So yeah, definitely. And also, I don't know how much you know about the Strength in Places Fund, but this also is looking at collaborations across a huge number of partners, whether, you know, usually there's a university at the heart of it, and then, you know, the SMEs, there are big businesses, investors around that, just to drive innovation and drive you know, economic growth within regions and certain areas, which obviously then has a knock-on effect across the whole of the UK. So yeah.
Fascinating. Thank you.
Can I just add one thing as well?
Please.
Less about sustainability, more about measuring impact. And this is something that, you know, where investors sometimes struggle to invest in businesses that are trying to deliver social impact, because it's so difficult to measure that impact, and because the actual impact is sometimes not seen for years. It's a long-term event. So that's another thing that we're really trying to address, is how we can measure social impact in a really standardized way, if you like, so everybody does it the same way and we can all see the results, and the data we get back then will really help to, you know, to drive more investment into that area.
Fascinating, very good. And question coming in from Mads Muller, who's the sort of head of technology investments at Danfoss over in Denmark, big corporation there. He's asking, particularly for Stéphane and or Paul, could you elaborate on how you have organized yourselves within Pernod Ricard and why? So, Stéphane, perhaps you want to start off. You know, how are you organised within Pernod Ricard?
Are we organised, you know, in the relationship between Convivialité Venture and Pernod Ricard?
Yes, exactly. Are you independently owned or run Convivialité, you know, or are you in effect a unit within and owned by Pernod Ricard? Who do you report to? You know, what's the sort of, in effect, the organizational structure? Is it a small team and you call on business unit managers, those types of questions?
Sure. So yeah, Convivialité Venture we have only one LP, it's Pernod Ricard, and we have an investment committee with our group CEO and 3 top execs that we meet every second month, where we give them back what we see, and to, you know, get them engaged and supportive and get their approval for any investment we do. So we work with an IC, and it works really well. They're very quick and agile and get it very quickly. So that's the way we operate, with small teams, small investment teams across the 3 regions, looking at the deal flow and the investment opportunities, and bringing it back to our governance, our IC based in Paris.
Okay.
The only thing I'd probably add to that would just be when we got together with Pernod Ricard and we began working on the concept of them starting a venture group, you know, there's a fundamental question that's pretty important that comes right up front, which is, what do you want to name the entity? And, you know, so we have companies that have very strong kind of consumer brand names, like Goodyear is Goodyear Ventures. JetBlue is JetBlue Ventures, because they spend, you know, billions of dollars advertising their brand to consumers. Pernod Ricard is more subtle in terms of kind of their approach to that, because they're essentially a parent company to a series of brands that are very, very well known to their consumers. And so when we began doing the work with Stéphane, I think we sort of mutually came to this place that said, hey, we think this concept of, you know, what we're trying to do is get to Convivialité. That was really a central strategic goal of the organization, of Alex Ricard and the executive team. And so we kind of came up with this concept of, well, let's do Convivialité Ventures, right? Let's name it after the goal, but also because it's kind of a cool name and it's French and it sounds very sophisticated, but it communicates what we wanted to communicate. And I like telling people this, but Convivialité Ventures is the first venture fund in history formed to fund fun, F-U-N. And that's what we do. And it's actually fun. So it's been great to be part of it.
Fascinating. And then an anonymous question coming in, asking, what new models of fundraising do you see emerging in the CVC space, and how do entrepreneurs feel about them? So, I mean, broadly, if you think around traditional funding styles, like the Pernod Ricard Convivialité sort of model, where you have a single LP, they they have a sort of defined, probably annual budget. You know, sometimes it's a specific fund which they can invest over a number of years. That's a sort of traditional approach. It looks a lot like, you know, a VC just with a single LP though. But we're seeing traditionally that model opening up. Some of those corporate venture units or funds then getting external limited partners to come in to kind of leverage the parent company capital, still often with a strategic focus. There might be more institutional LPs, there might be secondaries investors who take some of the traditional assets or portfolio already held and then sort of support a future deal rounds. But there are also other, you know, more multi-corporate funds being formed where, particularly around a theme, you know, that they might have different angles and again provide more power together. So we're seeing a number of those different models coming together. Obviously, you know, some of them are opening up because the parent company can't afford or doesn't want to continue funding wholly or solely, or they're doing different types of funds, multiple units in the way that Alphabet has, you know, looking at specific areas, later stage, earlier stage, more private equity or follow-on deals and growth capital. And it's very much becoming a lot sort of more developed as an asset class. But Paul, perhaps you want to sort of, any other models that you're seeing, given obviously you do the inside out as well, and then Sukhjinder, perhaps, you know, which ones appeal most to you if you were doing your next startup in a few years' time?
Well, Jim, I think you've touched on a number of them, the sort of the aggregation of people's interests, the sort of the auto tech ventures and union labs and people like that that are coming together around themes, whether it's mobility or hard tech or whatever it might happen to be. I think what we're seeing is, you know, we see some kind of like, you know, sort of niche approaches to this. You know, we have clients that have done separate entities with quite literally separate bank accounts, which is a very nice luxury to have when you're running a corporate venture group. So you're not having to go back to the treasurer and the CFO for every investment and coming off the balance sheet. It's in a dedicated pool of capital. So that's a trend line I hope we see actually beginning to grow, because I think it just makes it a lot easier to do. And then specifically, kind of tactics that we've seen, and we've helped some of our clients deploy these, is that, you know, when you're running a CVC, I mean, I've spent most of my career on the other side of the table, sitting as a general partner in a really good firm, and you know, we have a project and it's a good project and we're excited about it, and it's, you know, we think it's going to be a big exit, and then we hear that a corporation wants to put money in, and then we're like, well, now tell them we're too busy. Like, tell them the round's closed, tell them something, right? Just they can go away, because, you know, I'm only going to share this deal with Greylock or Sequoia or whatever it might happen to be. And so in those instances, what we're training people, and I think the you know, the Pernod Ricard guys have done a great job with this. The Hypertherm guys have done it. The TDK guys have done it. Goodyear's doing it, which is we're really kind of a two-pronged approach. We go in leading with the value add. Okay, look, let us tell you who we're going to partner with, how it's going to generate revenue for you, how it's going to generate contacts, you know, et cetera, to improve your business, your startup business. So job one, make you, the CEO, happy from that perspective. And then job two is to make the general partner, who's basically the effectively chairman of the board of that startup, make them happy. And so in those cases, we've constructed custom convertibles to be able to go into those opportunities. So not convertible notes like you think about in a SAFE or in a seed stage round, but instead in a highly competitive Series B, Series C, we'll come in and say, look, we'd like to be able to put 2 million, 3 million, 4 million into this project. We'll agree to the next round price. We'll take a slight discount on that, and we'll deliver all the strategic benefit, the customer relationships, the partnerships. We'll deliver all that starting now, even though we don't technically get the ownership until the next round converts over. And that's turned out to be a pretty compelling argument with boards, because they kind of can't lose. They're going to raise more money. Why not take 3 or 4 from these guys who claim they're going to be able to help us in the field, and our CEO wants to do it anyway. So those are some of the things that we're working with that are a little more sophisticated.
That's fascinating. Sukhjinder, which model do you like?
Yeah, no, so I think Paul just touched on a couple of ones. So what I'm seeing now at the moment, look, as a CEO, as a startup, you know, what you want to preserve is that you're able to do the business. But the last thing you want is being tied down, you know, hands being tied down. And I have, let's say, a bad experience, which I'm happy to share, is that where you get 2 strategic partners in. So, you know, we needed money and a strategic partner came in. And you know what happened? Nothing. because they both had different views on it. So it's really, what I've seen is who is leading really from a strategic point this venture. And if you have, you know, let's say benefits could be brought in by a tactical partner because they have money, or they could bring in technology, great. But having two, let's say, big dinosaurs in one organization, that did not work for me as a CEO, because I didn't know where to go, left or right or straight, because they were pulling from every side. So for me, the preference is to really have one strategic partner which has this goal, has this vision, and then besides, if we need some money, bring in people which can complement it, maybe with some specific technology or with specific customer access, and benefit from there. That is where I've seen the most successful things I've done, at least.
Yeah, it's interesting. I mean, there's definitely different entrepreneurs have different views around the single versus two or multiple corporates. If you just have one, there can be that perception for a follow-on round that if they don't invest, there's something there, or they're going to be the natural acquirer, and it can put off some customers. So it's definitely a challenging piece getting CVCs involved. There's no clear answer on some of those, but fascinating. But a question over from Jesse Chang. Right, feels like we could carry on. We're coming towards the sort of the bottom of the half-hour mark, and we should stop there. But a quick question from Jessie Chang over at Wise Ocean in Texas. She asks, how can middle-sized corporations leverage open innovation to grow, i.e. not through corporate venture capital, but where they have certain resources such as clients, channels, or technology? Is there a better partnership model? You know, if you think about it from an entrepreneur, she's broadly looking for 5 things: capital, customers, product development, hiring, and an exit, and then now increasingly a 6th one, which is that sort of geopolitical or regulatory tax. But you know, if you're a mid-sized, Mittelstand type corporation and you don't necessarily have the free cash flow to do a lot of venture deals, how can you leverage your strengths to support and then hopefully reap some of the benefits? Paul, what are you seeing on there? And perhaps Helen as well, if you got different perspectives on this side as well. But Paul.
I think it's a terrific question. If you'll note, when you go back to the Mach 49 presentation, I had that 3rd category, which is without a CVC, how can you use strategic partnering to get the most out of the innovation economy, out of startups, or it might happen to be. You know, I think we can take this conversation offline, but there are many different ways you can do it. I mean, you know, people will come in and they want to start a CVC, and they'll want to have at least sort of $50 million, sometimes $100 million. We can get by with less, that type of thing. But for less than $1 million, you can have a Sukhjinder Singh. Actually, he cost a fortune, but for less than $1 million, you can incubate a startup like a Pear.AI. And rumor has it that startup returned more than 100x the incubation fees that went into that company. It's not
rumors, Paul, rumors.
And so when you start thinking about it, there are other tools in your toolkit that you can start to use that maybe works your way up to where eventually you're going to be able to be in a position to have a CVC, but you can do a lot with a little without having to start a fund.
That's a great point. Okay. Helen, anything to add from your side?
I mean, I was really just going to add something from, this is a UK perspective and it is a funding perspective, is that something that I'm trying to address again within my specific challenge is actually a lot of SMEs don't need that much. A lot of this very early startup need less than £50,000 to really get them moving, and actually getting an investor to be interested in that is almost impossible, which is where we come in and we try and get funding, you know, to those businesses in that way. But actually for us as well, it's quite difficult. So this is something where, you know, the accelerators I was talking about earlier and that whole collaboration between different sectors is really coming into play to support those kinds of SMEs. So yeah, just coming at that question from a slightly different point of view and UK perspective.
Perfect. And then final question, then we'll close it off. But it's a really good final question. So perhaps people will have different perspectives. But it's around the transfer of knowledge. You know, if a lot of the goal of corporate venturing is getting strategic sense of some of the disruption or transformative technology out there, how do you organize yourself best to get that transfer from the startup venture back to the corporate, or maybe vice versa as well? So Stéphane, do you want to sort of kick off with this? Because obviously that's a key part of what you're trying to achieve.
Yeah, no, thank you. No, it's a great question, because this is also one of our key objectives. You know, all these learnings, how do we capture it and bring it back to the mothership, to the corporation at a broader level, so that we are not perceived only at the one, you know, looking at the future, while the others are still, you know, focused on the core business short term. So there is a person in our team actually now whose part of her job is to capture all these learnings, either from the interaction from the portfolio or just basically from what we see around us, from you know, interacting with startup and the whole ecosystem, and summarizing that and bringing that back to the ecosystem through webinars or, you know, content that we bring within the mothership or within the organization. We think it's very important and part of our role to bring that back, you know, so.
Fascinating. Any other final points, Paul, Sukhjinder, perhaps? Okay, in which case I'm mindful of time. But as you can see, hopefully on the screen, it's a great pleasure and honor for me to be able to listen in and learn from these real superstars. I particularly want to thank Paul, Helen, Stéphane, and Sukhjinder, you know, for their sort of insights. But obviously, you know, from my point of view, there's a great team effort within GCV that sort of comes together to make these things happen. So thanks, Kalyan, thanks all the rest. But really wonderful insights. The recording and slides will be available afterwards for attendees, those who have registered. But obviously, I'm sure Paul, Sukhjinder, Stéphane, and Helen will be available if you've got follow-up questions, and do let us know if we can help reach out and connect. And perhaps, Stéphane, you might be interested in one of Helen's colleagues, Hugh, who's doing something around innovative, transformative industries, and glass is one of those challenges. So your renewable glass might be perfect for him on that side.
Great to hear more about it.
Wonderful. Yeah. Well, thanks everyone. See you soon. Okay.